Howdy folks, Joe DeSanto here. Thanks again for joining me in another YouTube video, or perhaps maybe this is your first of mine, so welcome. In this video, I am going to just be running through a glossary of common investing terms that you'll be running into if you're going on a learning journey of investing. I will see you in the video. I'm Joe DeSanto, by the way. I'm an independent CFO and business consultant. I actually spent most of my career in Los Angeles building a few multi-million-dollar businesses, and I've since semi-retired, and now I help other businesses and individuals manage their money and plan better for their future. So if you're interested in small business, personal finance, and real estate advice, please subscribe to the channel. Thanks. All right, folks, so on kind of a journey to create videos to complement content that I've made on my website, playlouder.com, because some people like to read, some people like to listen, some people like to watch and listen. I'm kind of a listener. So I'm just going to get started. I got about a dozen terms here. I'm going to read off the what is question and then answer it just off the cuff, like right out of memory. Pretty crazy. Okay, first one. What is a stock? So a stock is a company. Usually when you invest in stocks, you are buying a little piece of a company, a publicly traded company, and you will participate in the growth and or demise of that stock while you own it. Obviously, the hope is the stock either continues to produce the fruit that it's producing, and maybe that comes to you in form of dividend. That would be a dividend stock. Sometimes you're not going for dividend, or the stock doesn't actually give a dividend because it takes all of the money it makes, all its profits, and reinvests it in the company to grow more. That would be called a growth stock. In the case of a growth stock, you're just essentially trying to build your equity or grow your equity or your invested capital. And with the dividend stock, you would be trying to generate potentially spendable cash flow from the dividend. Though if you're not at the time in your life where you want the spendable cash flow, but you like the profile of the dividend stock, you might reinvest the dividends and buy more stock with the dividends. There are tons of different types of stocks out there that fall, different places on the risk spectrum, different places on the sort of asset allocation of your stocks, but they all kind of function the same. You buy the stock and you go up or down with it. Okay, next one. What is a bond? A bond is essentially you giving a loan to somebody for the promise of your capital back plus an interest rate. So you're not going to participate in any of the profits of the company as they happen. You're not going to participate in any of the growth of the company. I should say in the company if you're giving a corporate bond. Or if you're not doing a corporate bond, you might be doing a U.S. Treasury. You might be doing a municipal. But essentially what you're doing is lending money with the hope that you will receive your principal back plus interest. Now, one thing I want to mention about bonds is that when you buy a bond, let's say you buy a 20-year U.S. Treasury, you can either see that bond through to maturity, meaning you literally hold it for 20 years, and say it was a 5% 20-year bond, you would get 5% interest each year as you hold it, and then at the end of 20 years, you'd get your principal back. However, you could also sell that bond before maturity in the secondary market and possibly take a loss on the bond if rates have gone up, or you might make a larger profit on the bond than even if you held it through to maturity if rates have gone down. And then also, I'll say with corporate bonds, they grade corporate bonds as an A, B, C grade. The A grades are like the high quality bonds. Usually for the higher quality the bond, the lower the rate you get. The lower quality the bond, the higher rate. Really low quality bonds are commonly called junk bonds, though nowadays they call them high yield bonds. And obviously the lower the quality of the company, the higher risk of default and you losing your principal and not getting that interest. So every investment, whether it bonds or not, comes with some risk, though they say that the most riskless investment out there the world over is the U.S. Treasury. So far, that's proved to be true. Let's hope it continues to prove to be true. Okay, moving on to number 3. What is an ETF? So ETF stands for Exchange Traded Fund. Okay. In general, a fund is a collection of something. So instead of buying a stock and buying the individual stock, you might invest in a fund managed by some fund manager that buys the stocks for, the fund, makes all the investment decisions and puts together a collection of stocks that by buying the fund, you buy into the whole collection of investments. But funds could be made up of just stocks. They could be made up of stocks and bonds. They could be made up of a variety of instruments. They could be made up of derivatives. But when you buy into the fund, you buy into that lot of investments that is managed by that manager. Now, funds used to generally come in the form of mutual fund, which is just what I described, though the way you would purchase a mutual fund is different. You could only buy a mutual fund like once a day, and oftentimes there were minimum amount requirements and things like that. That's actually still true today, but at some point we created what's called the exchange traded fund, meaning it's like, hey, let's take the mutual fund, but let's make it easier to get in and out of, and let's remove the minimum investment requirement. So essentially, instead of a stock being of a company, it's like a stock that represents the fund, and whatever the fund value is less the amount of shares equals the share price, and you can just go buy one share, you can buy 20 shares, so you can buy them on the open market, when the market is open. So that's an exchange traded fund versus a mutual fund. Probably next I'm going to do mutual fund. Okay. All right, next. What is a mutual fund? Who would have thought? Okay, well, I basically just explained the mutual fund, but a mutual fund is kind of like an investment group, you could say. I mean, a mutual meaning a bunch of people came together, piled in money together, gave it to a fund manager to make them money, and that fund manager went off and invested in whatever that fund manager invested in. Now, many mutual funds are sector specific, approach specific, strategy specific, blah blah blah. It could be a bond fund, it could be a stock fund, could even be some fund manager that trades options. Who knows? But there's a whole bunch of kinds of funds out there, and when it's a mutual fund, it essentially is indicating that it is purchased, in a certain way. Mutual funds, I think, can only be purchased at the end of every day. And also often a mutual fund has a minimum investment requirement. The previous question was, what is an ETF, exchange traded fund? And that's essentially, saying, hey, take the mutual fund, remove all the minimum requirement, and let it be tradable as a security during the trading day. Easier to get in and out of, no minimum. That would be an exchange traded fund as opposed to a mutual fund. Mutual funds are around first. And that, if you wanted to get into a collective investment, that's pretty much how you did it. Mutual funds could, again, be, a collection of stocks, a certain strategy. It could also be based on an index, as can an ETF. So mutual funds still exist. I think the more common approach to getting into a fund investment is as an exchange traded fund these days. But there are mutual funds out there that are not exchange traded, and they may be the profile and or types of investments you want to get into. And the only way to get in is to have the minimum investment and follow the rules of the fund. Okay, that's a mutual fund. Number 5, next one. What is a REIT? So a REIT stands for Real Estate Investment Trust. And a REIT's interesting in that it's a real estate investment, okay? But it's like, think of a company that buys and manages real estate. That's what the company does. It's like a real estate, either development firm or asset management firm, maybe some real estate companies just do malls, some do medical office, some build shopping plazas all over the country. But the company is there to invest and make money in real estate. Take that kind of company, turn it into a stock, and now you have a REIT. So it's basically like a stock in a real estate company. Now, it's called a real estate investment trust because, well, I don't know exactly the details, but I can say that companies that fall under the real estate investment trust banner have different requirements in terms of distributing income and so on than a regular stock. There's a couple kinds of stocks. There's just a regular common stock. There is like unit trust. There's real estate investment trust. There's a few different types of setups for certain kinds of stocks, and they have a little bit of rules of how they operate and how they distribute profits to the shareholders. So real estate investment trusts are always real estate, but it's like you're buying a stock and you're kind of investing in real estate at the same time. Often, as is the case with real estate, the goal of real estate is to generate cash flows from the rents, that people pay in these real estate projects. And usually REITs have good dividends, essentially. They produce spendable cash for you on a monthly, quarterly, or semi-annual basis. So people like them to get exposure to real estate, get cash flow without investing directly in the asset where the real estate asset where it would be less liquid, more difficult to get in and out of. But the flip side of that is when something is traded so easily and can be gotten in and out of easily on the market or in the markets, the price of the REIT is not just about the value of the real estate or the cash flows or whatever. It is subject to trading volume and the market conditions overall. Whereas like real estate could be doing great, but the market in general is doing bad. So all REIT prices are dragged down with the market just because everyone's piling out, getting out of the market right now. Whereas if you had the money in those real estate investments directly, that may not be the case. You might not see as much fluctuation in the value of your equity in the real estate if it's not traded on a daily basis in the open market. All right, moving on. Number 6, what is a market index? So an index is essentially a way to track a collective value of something in the market. So that something could be the collective value of the real estate sector in the market, the collective value of small caps stocks in the market, the collective value of the biggest industrials companies in the market, aka the Dow Jones Industrial Index. The S&P 500 index tracks the top 500 most valuable companies in the U.S. So there are different companies that, sort of create these indexes, like Standard & Poor's is one, the S&P 500. And we kind of measure the overall health, of the market, maybe even the economy, you might say, to some degree, by looking at the top 500 companies in the country and putting a value on them at any given time and watching the value of these companies collectively go up or down. That becomes an indicator of how the market is doing, right? So we have the Russell 2000 index, we have the Dow Jones Industrial Index, we have the S&P 500 index, but we have S&P, the Standard & Poor's does indexes on sectors of the market, like I said, real estate, utilities, whatever. You might have indexes for value stocks. So there's a lot of different companies out there that create these indexes. And then oftentimes what happens is these days, we would see that other companies have created an exchange-traded fund that just tracks the index. So, and you hear this a lot. You just go, simple way to invest. Go buy S&P 500 ETFs. So a Standard & Poor's based investment pool that trades as an exchange-traded fund. So you get exposure to the top 500 companies. There's very low cost on the ETF, index ETF, because it's just looking at the index and doing what it does and mirroring that. So you don't need an expensive fund manager to like buy and sell stocks all day. You just stay in balance with the index that you're tracking. So that's what an index is. Number 7, what is risk tolerance? Well, I do a video on risk tolerance, or what I call the spectrum of risk. I've done a video, it's a longer, more detailed video, but risk tolerance is a funny thing. I always thought that was a weird question when some financial person would say, what's your risk tolerance? Like, what's your tolerance for losing money? And I'd be like, well, it's 0. I have no tolerance for losing money. It was really hard to make the money. I definitely don't want to lose it. So it always seemed like a stupid question, but really the way I think about risk tolerance is this. It is your willingness to keep working and or your ability to keep working in a sharp and or prolonged market downturn, right? So say you're about to retire and it's 2008, January, and then cut to June of 2008 and you've lost 60% of your money. Well, all right, maybe it was a year later, by then you lost 60% of your money. Well, now your retirement's sort of in peril and you got to keep working, right? So what was your risk tolerance then? If you were like, definitely I don't want to keep working, your risk tolerance was 0. If you were 20 years old at that time and you had a little bit of money in the market, your risk tolerance was very high. And also you're like, I'm going to buy all this stuff, as much as I can and watch it go up. So risk tolerance is generally tied to your age, but also subsequently, is that the right word, tied to your willingness and ability to keep working. That's how I look at it. So risk tolerance, there you go. What is diversification? Diversification is spreading out your investments or your capital, your investable capital, over a variety of investments so that if one investment fails, goes to 0 or goes to half or whatever, you don't lose everything, or half of all your money. So if you invest in just one stock, all your money, and that stock goes down by 90%, well, you've lost 90% of your money. But if you invested in 2 stocks, one goes down by 90% and the other goes up by 100%, well, you've made, is that 10% on your, 5% on your money, if you had split your money evenly over the 2 stocks. And obviously, the more stocks you spread your money out, the more you are diversifying and spreading your risk out. Now, you can diversify in multiple ways. You can diversify by the instrument you buy, whether it's stocks, bonds, commodities, gold, crypto, diversify over asset class. But then you can also diversify within an asset class by over, like, say, the number of stocks, but also the sector in which the stock is. So you might have some high-tech growth stocks, risky stocks. They don't make a profit yet, these companies, but their new product might change the world and they'll 100x. Versus the blue chip, industrial that pays a 3% dividend and is a dividend king and, has grown steadily over the last 100 years. You can diversify both by sector in a particular asset or over multiple assets. And, within each asset by the type of asset, or the sector in the asset. So that is diversification, and it's relatively tied to what we call asset allocation, which I'll talk about next. Number 9, what is asset allocation? So asset allocation is not dissimilar from diversification. They sort of, you might say in some ways they're the same thing, but they sort of work together, I think. Asset allocation is more about spreading your risk over different assets, number one. So don't be all in stocks. You might be in stocks, you might be in bonds, you might be in real estate, you might be in gold, maybe you got a little bit in Bitcoin or other, altcoins, some crypto. You might have your money in alternatives like oil wells if you want to do something like that, notes, who knows. There's a variety of asset classes that you can invest in. And that's different than sectors within an asset. Like within stocks, you could have growth stocks, high-tech growth, blue chips, industrials, value, small cap, medium cap, large cap. We kind of break up any particular asset in a variety of things. In real estate, you can have single family, multifamily, commercial, industrial, land. In commodities, you could have gold, silver, other metals like, I don't know, copper, zinc. You could have mineral rights on land. So some of the asset classes overlap a little bit, like mineral rights. A land purchase for mineral rights is a perfect example of kind of a blended asset class of real estate and mineral rights. So asset allocation, one is about risk diversification, but it's also potentially about diversification of equity growth versus income in your portfolio. So as you get older, when you're young, you just want to grow your money. You're going to be working all the time, right? So you might have a certain asset allocation that is very higher risk and focused on growing your investable capital. As you get older, you get towards retirement, you're like, okay, one, I can't lose the money that I have, so my risk tolerance has gone down. But also, I need my money to give me spendable money because either I want to work less or I'm going to stop working, I'm going to retire. And I'm not just going to spend my pot of money. I want to invest my money now in the type of assets that produce spendable cash. So that might be dividend stocks. It could be notes. If you want to go low risk, it could be treasuries, corporate bonds, municipal bonds. It could be anything that produces cash flow. So you can look at your asset allocation that way. Am I allocated more towards cash flow in dividends or more strictly towards equity growth? And if I might be somewhere in the middle, or I might be like, I'm kind of equity growth, but I don't want to be super high risk, so I'm going like, value or something. So it's like asset allocation both serves for that person, but by looking at your asset allocation, you're de facto potentially diversifying and also spreading your risk. So there you go. That is asset allocation. Number 10, risk reward. We hear a lot about the more risk, the more reward. This does tie into risk tolerance, of course. Risk tolerance is more about you and like where you are in your work to retirement journey, and also what keeps you up at night a little bit as well. And the risk reward is more about looking at the spectrum of risk of the different asset classes out there and finding one that kind of fits within your tolerance and your place in the work to retirement journey. But they generally say higher risk, higher the reward. Lower risk, lower the reward. No pain, no gain. So I think we all understand that, but it's like understanding why a particular asset class or a particular type of investment has more risk and more reward. And also there are some investments in there that I think, like real estate in general, for me, it's not always true to say this, but in general for me, it had produced like higher return for, I think, relatively speaking, lower risk than a lot of market, investments like stocks or whatever. Cryptocurrencies, on the other hand, produce potentially high reward if you get lucky. but high risk. Literally you could just like lose all your money. Like you go from like $100 to $0, in a short period of time. But there are a lot in the cryptocurrency space. There is literally a lot of scams. Call them rug pulls. The kids call them rug pulls. So yeah, so risk reward is really more about assessing the asset and or the instrument, and like what that risk reward is a risk reward like a better formula than something else, and does it fit within your risk tolerance and fit within your goal in your working to retirement journey. Next one, number 11. What is compound interest? They say it's the eighth wonder of the world, and if you get started early enough, it definitely can seem that way. But compound interest is essentially your money making money. So you start out, say, with $100, and you put it in an investment that is going to yield a 10% return annually. So at the end of the first year, you have $110. Now, you then throw that $10 into the investment. Now you've invested $110, and that gets 10%. So what's that at? You now made $11, and now you invest 100, and you get it. You take your winnings every year, you reinvest it, and your winnings grow winnings. Now, we talk about compound annual growth rate, and where I want to add a little bit to like the basics of compound interest is that a lot of times we talk about, especially in the stock market, like, what was the compound annual growth? And if a stock doesn't dish out a dividend, you're never actually taking any gained cash and reinvesting it, right? If some stocks that don't give dividends, the growth stocks, high growth stocks, they just grow, right? So you put $100 in, and then hopefully 5 years from now it's worth $200. It's not because you actually compounded anything. It's just that the stock grew. However, to measure the value of that against something else, you would reverse engineer a compound annual growth rate. Meaning you'd say, hey, my money doubled. It grew 100% in 5 years. So I could say my compound annual growth rate was roughly 20%. It's actually not, because of if it were actually compounding, it'd be a little different. But the basic gist is my annual growth rate was about 20% in that case. And the compound annual growth rate is really like the unit of measure that we use to assess whether or not an investment has performed well, or when we're deciding what to invest in, we look at what the potential compound annual growth rate would be. Also, the compound interest or compound annual growth rate, when you're doing your financial planning for your life, hopefully you got my Financial Independence Roadmap course and you did the spreadsheet and you said, oh, I got to save this much money every year, but that savings has to make a compound annual growth rate of 7 to 10%, hopefully more, hopefully 12, 15, even 20%. So my money can make money while I'm at my day job, and I can get to the promised land of financial independence on my hopeful time horizon. So it is essentially what we're going to sort of evaluate our savings growth at, and then compare that, with the market in general, and, and other potential investments. So compound interest, obviously, eighth wonder of the world, but really understanding that what the compound annual growth rate is and how to use it as a unit of comparison or a measure of comparison is the extra part of that explanation. What is yield? Okay, so yield is a common term that refers to a dividend percentage that you get back, or if it's a bond, whatever the percentage is you're going to get paid on your money. Now, you could say, hey, isn't that kind of like compound annual growth? Yes, not, yeah. Like if you were going to invest all in bonds and your money was going to make 7% a year, and you didn't take the money, you reinvested in more bonds, yeah, like you could say that yield essentially becomes a compound annual growth rate. But I think yield probably is more saying in the sense that you're going to take the money. So you say, hey, bondholder, U.S. government, here's $100,000. Great, I'm going to buy a 20-year treasury at 5%. My yield is 5%. And I'm going to get that 5% or $5,000 every year. I think they distribute it, 2.5% twice a year, right? So that's your yield. For a dividend stock, the dividend is actually basically an amount of money they give you for every share you own. So say, you bought a share of a company for $100, and the annual dividend they give you for owning that share is $10, your yield for the year, annualized yield, would be 10%. So you bought the stock for $100 and you got $10 for the year in dividend. That's a high dividend. That's a high yield. But it's out there. But probably risky dividend that very likely would get cut under, tight conditions. But nonetheless. So there you go. That is a summary of a dozen commonly used terms in the investment landscape. And hopefully that clarified a bunch of other reading you had been doing where you keep seeing these terms or you're exactly sure what they were all the time. All right. I'll see you in another video. Thanks so much.